Good morning, all you magnificent melon heads of the world, and happy GDP day, everybody. Today is Thursday, April 25th, 2024. Oh boy, guys, it's going to be one of those days. Let me just say, Microsoft or Google, Alphabet, they better pull a rabbit out of the hat this afternoon because this market is in for a rough day. Where to begin? The 1-2 punch of GDP and Meta earnings. Wow, just markets getting crushed this morning. First thing, top story today, GDP, gross domestic product. Real GDP growth in the U.S. for the first quarter of 2024 came in at 1.6%. That is a massive miss, a huge miss. The market was expecting somewhere, we saw market forecasts of 2.5%. The Atlanta Fed's GDP Now tool was forecasting 2.9% growth. We were hearing so much about, this resilient consumer and economic resiliency and the soft landing. And then today we get the GDP report and it's 1.6%. That is a massive miss. Also, for those asking, GDP is adjusted for inflation. So that does, it's adjusted using PCE, which is the lower end of the inflation measurement spectrum. But that is an inflation adjusted number. But just a huge, huge miss. Now, some of you might be saying to yourself, okay, well, we got slower economic growth. Maybe the Fed pumping the brakes on the economy is starting to have the desired effect. Maybe this means the Fed rate cuts are going to come sooner, right? Hey, the Fed just got the all clear to cut rates. No, they did not. Because on top of that lower growth, we got a higher increase in inflation. The PCE, or personal consumption expenditures, the core PCE price index, quarter over quarter, and this report came in at 3.7%. The market was expecting 3.4%. And last quarter, that number was 2.0%. So the rate of inflation has almost doubled quarter over quarter, despite economic growth slowing. This GDP report was the worst possible outcome. I mean, shy of a big negative reading and, officially entering a recession. Obviously, that would have been worse. But man, if you're a Fed watcher and you were hoping for something from GDP to give you some reason to go bid up tech stocks, you sure as hell did not get it this morning. That was a just terrible all-around report. We'll get into the nitty-gritty of what sectors are seeing growth and what sectors are seeing contraction, but just doesn't do anything for you guys. I mean, the market immediately started dumping as soon as that happened. Now, the other big story was Meta earnings yesterday. And this was interesting because I want to set the table for Meta earnings. Keep in mind, we had terrible earnings from Tesla. All right, Tesla earnings were down like 47% year over year, horrible EPS, missed on every possible metric. But Elon Musk says robotaxi and AI enough times, and we're going to buy all these brand new GPU lips, and all of a sudden, Tesla stock rallied yesterday, right? So that's the setting heading into Meta earnings. And then Meta's earnings are the opposite. Phenomenal earnings growth over at Meta. I mean, look at some of these numbers here. Revenue was up 27% year over year. Earnings per share, Meta's earnings per share rose 114% versus a year ago. That's a massive growth in earnings. Phenomenal top and bottom line numbers. Now, that was all driven by basically cutting people. I mean, Meta laid off tens of thousands of people last year. They were just a bloodbath among Meta employees. But the year of efficiency is over. And all that initial excitement over the top and bottom line numbers was gone just as soon as Zuck started opening his mouth. In particular, their CapEx spending, the investments Meta intends to make this year, they increased their capital expenditures to $35 to $40 billion. That's up from, I believe, 30 to 37 is what the market was expecting. And then Zuck just started talking. The guy mentioned AI on the earnings call something like 80 times, talking about investments in smart glasses. Are we still doing that? Wasn't that like Google's big miss 10 years ago? Remember all the talk about glass holes, people walking around with these giant things on their heads, scanning information? Well, Meta's still pumping money into that. They're still pumping money into the Metaverse. Well, I guess they rebranded the entire company around Zuckerberg's pet project, so they can't just walk away from that. I guess Zuckerberg would rather continue burning your cash, you being Facebook shareholders. He'd rather keep burning your cash and save face rather than admit that it was a stupid idea and nobody wants their digital universe when there's sunshine and grass outside. Nope, he's going to keep pouring billions of dollars into that. And of course, billions and billions of dollars into thousands and thousands of NVIDIA GPUs. But unlike Tesla, where Tesla just said, we're going to buy all these GPUs, we're going to invest all this money. And GPU lips is my new phrase that I'm using to describe these things, because it used to just be brag about how many GPUs you own, and all of a sudden your company, magically the stock goes up, whether you do anything good with them or not. Well, Meta tried that yesterday, and it blew up in their face. The more Zuckerberg talked, the further Meta shares dropped. It's put up or shut up. The company's shareholders saying, you know what? It's time for these investments in AI to make some money. And Zuckerberg flat out said, guys, there's going to be a few years before we see any revenue growth from these investments in AI. Shareholders hated it. Meta stock is getting clobbered right now. Now, this could be a bad omen for Google and for Microsoft. I don't know, guys, because you're talking about the market had polar opposite reactions to Tesla versus Meta. And really what it was is the market just pretty much unwound a big chunk of the year-to-date trade, right? Tesla was way down year-to-date. Their stock rallied. Meta was way up year-to-date. Their stock sold off. So if that's the case, if the market is just walking back the last few months of trading, then we're in for a bloodbath all day today into this afternoon when Microsoft and Google report. But we don't know. It's the market is very peculiar. It's very finicky right now, but it's also very top-heavy. Any kind of problem like Zuckerberg spending too much money and they are punishing you. Now, what does this mean for NVIDIA's earnings? I don't know, to be honest with you guys. If we're just walking back the year-to-date gains, then NVIDIA's in for a bloodbath, right? Because NVIDIA is way up year-to-date. The stock's almost doubled. It's pushing $1,000 at one point. But at the same time, these Tesla earnings, they're spending a whole bunch of money on GPU lips. The Facebook earnings, a whole bunch of money on GPU lips. So whether good or bad, all these big tech earnings, they're all spending money at NVIDIA. So the rate of cash burn, the rate of money just blindly piling into these GPUs, forget any knowledge or figuring out, understanding what they're buying. They're just pumping money into it. That's still happening. So maybe NVIDIA posts really good numbers. And, keep in mind the round tripping is still going on. The investments in all their startup companies is still happening. And all these companies are getting higher and higher valuations as more and more private equity money starts pouring into them. Well, that's driving up NVIDIA's retained earnings also. So maybe NVIDIA rides to the rescue of this market. Or maybe, just maybe, call me crazy, the market is starting to wonder, what are we actually buying? What are we actually getting for this stuff? And wait till you see some of these stories about Meta and AI, a chatbot pretending to have a human child in the gifted and talented program in New York City public schools in response to a question from a parent of a special needs kid. This is some dark, twisted stuff these AI chatbots are doing, guys. And that's what we're getting for these tens of billions of dollars in investments in these chips. What a freaking mess. Does anybody stop to see what are we actually getting here? What are we actually buying? What are they actually doing with these GPU lips? Maybe you guys want to ask questions during the good times instead of doing the Monday morning quarterback thing after everything crashes. Hey, I just throw them out there. You guys do what you want with them. Also, we got earnings from Caterpillar, showed some interesting contractions in certain industries, growths in others. We got earnings from a couple of airlines today. There's a wheat shortage developing in India as their stocks are getting tragically low over there. Wheat prices have rallied 5 days in a row. It is a busy day here, guys. Why don't we shrink my big melon of a head and let's see what is going on in the market this morning. Guys, don't forget that like button for the YouTube algorithm. And if you're new here, hit that subscribe button and the notification bell right next to it so you can have your coffee with the melon heads every morning, because we do this one every day. Check out the S&P 500 right now, guys. There is your GDP report, that big red candle down. Right now, the S&P is down 64 points, 1.25% lower ahead of the opening bell and falling by the minute here. The Dow, even worse. Well, about the same, actually down 1.1%, 427 points lower on the Dow. And again, that big red candle, that started right on the GDP announcement. And the NASDAQ is worse than all of them, down 294 points ahead of the open, 1.68% lower for the NASDAQ. The NASDAQ is getting hit from both ends here. The Meta earnings are hurting the NASDAQ, and the GDP is also hurting the NASDAQ. So just terrible day there. And check out the US dollar. Look at that move in the Dixie. The Dixie was way down heading into this one, but then it just bounced right up. It's currently unchanged on the day, but there's that big green candle on the DXY. We got a stronger dollar on that GDP report because the combination of slower economic growth and higher inflation is kind of dashing hopes for any kind of a Fed rescue anytime soon. And so the dollar strengthened on that report. And we got yields moving higher again this morning. The 30-year Treasury, 4.824%. That's up 4 basis points. The 10-year Treasury, 4.724, up another 7 basis points. 4.7, guys, we're heading back to 5 here. It really looks like it. I dare I say it, it's a little cliche, but at 5%, something's going to break. I don't know what. I don't know why 5, but everybody was in panic mode last fall when we got near 5%. And, well, you know, Bill Ackman covered his short, and everybody decided the Fed pivot is here any day now, and the market rallied. But that has completely unwound now, and we got another data point today that says that Fed pivot, it's not going to get here in time. 2-year Treasury, back above 5%, 5.008. That's up 7 basis points this morning. Big moves in the bond market, guys. They are selling bonds, demanding a higher interest rate. Bond prices moving lower, sending those interest rates higher, and the 1 month is at 5.388. Looking over at the commodities board, interesting reaction from gold and silver. They're down here despite those higher inflation prints. Probably the stronger dollar may be having an effect here. The higher interest rates having an effect on precious metals. And the fact that, hey, those rate cuts probably not going to get here very soon, causing a little bit of selling in metals, which had been under pressure this week anyway. June gold futures, $2,332. That's down 0.25%. And May silver futures at $27.30, down about a nickel this morning, or 0.16% lower. We've got platinum is lower by 1%. Palladium's down 2.25%. And West Texas Intermediate crude oil, June futures at $82.28. That's down another 54 cents, or 0.65% this morning. Just taking a look at the silver chart. We've been watching this one, still below that important resistance line that we failed earlier this week. Looks like the bleeding has stopped. We found a footing somewhere around 27.20, although today it's going to be an interesting day today. We'll see how metals respond to this GDP report. And Bitcoin is selling off again this morning, down $1,187, trading at $63,060. Another big red day for Bitcoin here. But interestingly enough, yesterday was the first day that the BlackRock Bitcoin ETF did not see any cash inflows, the first time in 70 days. So it looks like that ETF story in the U.S., it has run its course, and now we're down to treading water here. But wait, there's more, because we are just a few days removed from Hong Kong spot crypto ETFs to start trading next week. So we could see another surge, maybe not as big as the first one, but we could see another surge of money flowing into crypto ETFs, or maybe the Hong Kong ETFs cannibalize the U.S. ones. I don't know, but starting on April 30th, Hong Kong listed spot Bitcoin and Ether exchange traded funds aim to start trading on April 30th. 3 asset managers that provide the products said on Wednesday. And those are the Hong Kong units of China Asset Management, the Harvest Fund Management, and Bocera Asset Management, the latter in partnership with local cryptocurrency firm Hashkey, said they aim to launch their products by April 30th. So it's possible we get another wave of institutional money, this time Asian institutional money flowing into crypto when that happens. I don't think it'll be as big of an effect as the U.S. one, obviously, but potentially some big moves in Bitcoin coming up next week. Now let's talk about the big story, the main one here, GDP. This is big, guys. Gross domestic product for the first quarter of 2024, the advanced estimate, real GDP increased at an annual rate of 1.6% in the first quarter of 2024. According to the advanced estimate released by the Bureau of Economic Analysis, in the fourth quarter of 2023, real GDP had increased by 3.4%. So let's, first of all, still growing, 1.6%. That is economic growth. So the economy is still in expansion territory, but the rate of expansion was more than cut in half in the last quarter. And the bad news just keeps coming. Let's talk about the increases here. The increase in real GDP was primarily reflected increases in consumer spending. There's those buy now, pay later and point of sale loans and credit cards still having their effect. We also had increases in residential fixed investment. The home builders still doing okay. Non-residential fixed investment, CHIPS Act, Inflation Reduction Act, still got a lot of spending going on there. And state and local government spending but that was partly offset by a decrease in private inventory investments. That decrease in private inventory investments, we've seen that in those PMIs, guys. The new orders are not coming in. The factories are not making new stuff. The companies are not restocking their shelves as they sell things because they know the consumer's hurting. So companies are reducing their inventory, less stock on the shelf. Well, that hits GDP. When you don't replace what you sold, your GDP goes down. Now, that was partially responsible for some of the really good earnings we saw, like at Target over the last few quarters. Target's numbers have been pretty good, even though their same-store sales have been declining sharply because they haven't been restocking their inventory, and it's finally starting to show up in GDP. Imports, which are a subtraction to the calculation of GDP, those increased. The increase in consumer spending reflected an increase in services that was partially offset by a decrease in goods. Within service, the increase primarily reflected increases in healthcare as well as financial services and insurance. So increased spending in healthcare, you got a little bit of inflation there. You also have a lot of that deferred medical procedures finally happening. We talked about that a lot with J&J's earnings. They were pretty good. A lot of elective procedures that were put off due to the vid, those are finally happening, driving increases in healthcare spending. You also have aging demographics, the boomers getting older. That's a little bit more money being spent in healthcare. And then financial services and insurance, I think that's probably inflation driven there, especially those increases in insurance costs. That's been a big contributor to CPI over these last few quarters. Within goods, the decrease primarily reflected decreases in motor vehicles and parts, as well as gasoline and other energy goods. Now, the decreases in motor vehicles, that's pretty interesting. That lines up with what we've seen from Tesla and GM. But at the same time, yesterday, we got durable goods orders, increases of 2.6%, and that was almost entirely driven by transportation. Well, I guess it wasn't motor vehicles. I guess it was planes. And, well, we've heard a lot about planes. Boeing isn't making deliveries. So where are these planes coming from and where are they going that somehow showed up in the durable goods orders yesterday? That was kind of interesting. Within goods, the decrease primarily reflected a decrease. Oh, wait, we talked about that one already. Within residential fixed investment, the increase was led by brokers' commissions and other ownership transfer costs, as well as new single-family housing construction. The increase in non-residential fixed investment mainly reflected an increase in intellectual property product. The increase in state and local government spending reflected an increase in compensation of state and local government employees. So there's wage inflation showing up as economic growth, even though really it's just after the fact cost of living adjustments that don't even begin to offset the rate of inflation we've all dealt with. The decrease in inventory investment primarily reflected decreases in wholesale trade and manufacturing. There's those bad PMI reports. And within imports, the increase reflected increases in both goods and services. Now, compared to the fourth quarter, the deceleration in real GDP in the first quarter primarily reflected decelerations in consumer spending, exports, and state and local government spending, and a downturn in federal government spending. And I had to read that one a couple of times. They are actually, with a straight face, saying a downturn in federal government spending. There it is, guys. I'm just reading what they put on the paper here. Those are not my words. Do not jump down my throat. But if you doubt that, feel free to let me know in the comments, and I'll thank you for the engagement. But most important here, I want to mention decelerations in consumer spending. All right, now deceleration, that doesn't mean consumer spending is falling. They did see, I think they said the increase reflected increases in consumer spending. So consumer spending is still rising, but it's rising slower, and it's not keeping up with the rate of inflation because consumers are broke. I've been talking about this for months and months now. People are spending less and less money on quality of life things, on optional purchases, discretionary items, because everything they make is going to the food, the rent, and the energy bill. What else we have? These movements were partially offset by an acceleration in residential fixed investment. That's a lot of new home construction, so we're still seeing residential fixed investment. Now, this is what really stings here, but none of that was really good, right? Slowing growth is bad for the economy, but it's good. Just saying, where's my rate cuts? Where's my ZERP and Burr? I want my number to go Burr. I want my stocks to go up. I want to buy more GPU lips with easy money that I can borrow at low interest rates, right? That's not happening because we got bad inflation on top of slowing growth. The price index for gross domestic product purchases increased 3.1% in the first quarter compared with an increase of 1.9% in the fourth quarter. The personal consumption expenditures price index increased 3.4% compared with an increase of 1.8%. And now this is what's really bad here. Core PCE. If you exclude food and energy prices, the PCE price index increased 3.7%. That's compared with an increase of 2.0% in the last quarter. So that's the rub right there. That's probably the single worst line for this whole report is core PCE nearly doubled in the last quarter on top of slowing economic growth. So if you're sitting here reading all this stuff about slowing, decelerations in consumer spending, great, Fed cut, and then you get to core PCE almost doubled in the same quarter. Well, shit, now there's no Fed cuts. And the market is once again going to have to reprice their expectations for the Fed coming to the rescue. If your whole investment thesis is dependent on the return of easy money, well, this report is not good for your bottom line here. And you saw the movement in stocks, guys. I mean, let's just look at the S&P. Still falling here, currently down 1 1/3% this morning. So GDP is really hurting stocks. But that's not the only thing hurting stocks this morning. We also got Meta's earnings. Absolutely amazing earnings for Meta. But they're just burning cash like it's going out of style. And look, if you just laid off tens of thousands of people and now you're burning billions of dollars on Mark Zuckerberg's face-saving Metaverse project, it's not very good optics for the most hated company in the world, especially while they're out there lobbying Congress to go ban their competition. By the way, screw TikTok. I mean, I'm no champion of TikTok, all right? The only thing I hate more than our government is the Chinese government. But still, Meta using politicians in their pocket to ban their competition, not a very capitalist headline there. But Meta more than doubles Q1 profit, but revenue guidance pulls shares down after hours. Meta's earnings were just straight up fantastic. All right. Facebook and Instagram parent company Meta said Wednesday its first quarter profit more than doubled, boosted by higher advertising revenue and a 6% increase on average price of ads on its platform. But its shares dropped sharply in after hours trading following lukewarm revenue guidance. Meta Platforms earned $4.71 a share in the January-March period. That's up from $2.20 a share in the same period a year earlier. Guys, that is a 114% increase in earnings per share for Meta. That's amazing. The ad revenue business over at Meta is booming. And, well, revenue rose 27% to $36.46 billion from $28.65 billion. Another amazing number, double-digit revenue growth. Analysts on an average were expecting less than that. For the current quarter, the Menlo Park, California-based company said it expects revenue between $36.5 billion and $39 billion. That's kind of a rub right there. All right, so they just reported $36.46 billion, and then the low end of their next quarter estimates are $36.5 billion. So sequentially, not very much growth here. So Meta is basically saying, guys, the big growth that we've seen, we're not going to keep up. We've got some very tough comps are coming up from year ago numbers are about to tick off. So Meta's year over year growth numbers are about to fall off a cliff. They're not going to look that good. They are still growing, but it was that guidance, that forward guidance of $36.5 billion on the low end, that really spooked investors. The analysts were hoping for revenue of $38.25 billion in their guidance. And, well, the high end of the range Meta gave just barely surpasses that. So it looks like the growth at Meta is not really going to materialize anytime soon. Now, keep in mind, Meta has been pumping tens of billions of dollars into their NVIDIA GPU lips. And, well, that forecast is saying we're not going to see any real material changes in our numbers due to all these investments. In other words, we're just burning cash for the sake of burning cash. And investors didn't like that. And then, of course, the conference call started. And oh boy, the conference call. Meta said it expects its 2024 CapEx to be higher than anticipated due to investments in artificial intelligence. Zuckerberg would mention AI 80 times on the conference call. 80 times. Just trying to AI his numbers higher, and the market saw right through it. They're forecasting expenses in a range of $35 to $40 billion. That's up from their earlier guidance of $30 to $37 billion. So they're just burning through cash on anything and everything. And look at what Meta's burning money on. Reality Labs, all right, which includes the Metaverse. a $3.85 billion loss at Reality Labs off of total sales of $440 million. The metaverse isn't going to make money, and they're still burning billions of dollars on the metaverse. Smart glasses. After Google burned billions of dollars on Google Glass and abandoned the project years ago, Meta pumping huge amounts of money into smart glasses. Maybe that eventually makes money, maybe not, but it's going to be years before it does. It's not going to do anything for shareholders. And then, of course, the AI investments. All right. Now, let's talk about the AI investments here. Look at this one. Now, I just got done my live stream on Friday talking about how meta.ai was actually pretty good. I've used Meta's AI tool a little bit, and it's much easier to use than ChatGPT. It's infinitely better than Adobe's Firefly product for generating images. And then I saw this story on a website called 404media.co. And good God, does this ever give me the creeps? Keep in mind, after tens of billions of dollars spent on AI, here's what we get. Facebook's AI told a parents group it has a gifted, disabled child. What? That is a true story, guys. I verified this from multiple sources. Meta's AI chatbot told a Facebook group of tens of thousands of parents in New York City that it has a child who is both gifted and challenged academically and attends a specific public school in the city. So some parent of a special needs child posts on this Facebook group of New York City parents, says, does anyone here have experience with a 2E child, which means both gifted, academically advanced, and disabled in any of the New York City gifted and talented programs, especially the citywide or District 3 programs? This is what a parent asks this parents group, right? This parent has a special needs child asking about special needs programs in a public city school system, and Meta's AI chatbot comes in and says, I have a child who is also 2E and has been part of the New York City Gifted and Talented program. So apparently AI chatbots are already genetically interbreeding with humans, according to what Meta AI is saying. We've had a positive experience with the citywide program, just totally making up a story about its human child and its experience specifically with the program at Anderson School, mentioning a specific school where this fake human AI hybrid that is gifted and disabled supposedly attends, talking about the teachers and staff were knowledgeable and supportive of my child's unique needs, just totally making up this story in response to a concern from a special needs parent in a mom's group on Facebook. This is what we're getting for tens of billions of dollars in investments in AI. This is what Meta has to show for it. And so when Zuck goes on the phone yesterday and says, we're going to spend another 38 billions on this, thanks, but no thanks. All right. If this is what this chatbot does in a freaking mom's group asking about special needs children, can you imagine what they're going to do in election season? Now, I get it. I'm a doomer and I automatically see the worst in every scenario. It's part of my nuclear training. It's been beaten into me over years. Is it really that hard to imagine that this might make a mess in election season when we're already at each other's throats left and right in this country? And then you throw this into the mix? And this anonymous member on Facebook very, very accurately says, Meta AI, what in the Black Mirror is this? Referring to Netflix's Twilight Zone knockoff Black Mirror, which is like dystopian sci-fi. Good God. An AI chatbot pretending to be the parent of a gifted, disabled child, mentioning a specific experience at a specific New York City public school. That's what we have to show for it. Oh, and look, it gets even better. Look at this one. Instagram advertises non-consensual AI nude apps. This is not Meta's program, mind you. This is what is being advertised on Instagram. Some jerk out there created an AI app that will take a picture of any girl and convert it into a fake nude. All right. This is being advertised. Instagram will take money from this people and promote their product on their app, part of this wonderful earnings that they just reported. And again, tens of billions of dollars invested in AI. And this is what we have. Take a innocent picture of a young girl and make a fake nude image out of it because Instagram doesn't already terrify and damage the psyche of young girls, right? Now we're going to throw this into the mix. If you're a parent of a young girl, how do you feel about this being advertised on Instagram? Does this make you want to use the Facebook family of apps? And this is what we're doing. I mean, AI is just going to shitify the internet on a grand scale. And yeah, oh, all these advances in human productivity, and oh, it's going to change the world. But what are we really getting? Fake posts about fake children with special needs in New York City public schools and deep fake nudes that abuse young girls. That's what Meta's doing with this. And, while they're using Congress to ban their competition, you know what? Good. Meta stock is down 15%. I'm glad to see this stock down. I hate this company with every fiber of my being. Meta stock is at $420.56, down $72.94, or just under 15% ahead of the opening bell. But again, guys, they're spending a ton of money on NVIDIA GPUs. So is Tesla. So is everyone and their brother. Everybody just wants to brag about how many GPU lips they have. And so NVIDIA is probably going to post another fantastic quarter. I don't know, but I tell you what, their growth better keep up, because look what happened to Meta stock when they announced that their growth was just going to slow. They're still growing, but their growth is slowing. Stock loses 15% ahead of the opening bell. Tough day for them. Also, we got to blow through these next few ones. Caterpillar stock falls as volume declines outweigh a profit beat. Caterpillar shares were dropping ahead of the market. The company's sales performance was impacted by lower volume, selling fewer tractors and bulldozers, though it was able to mostly offset that through favorable price realization. In other words, price hikes offsetting declines in volume. We've seen that across the board this earnings season. Some interesting things about specific industries. The company saw construction industries' total sales fell 5%, decline fueled by lower sales of equipment. Resource industry sales dropped 7%. That's farming and mining, also driven by lower equipment sales. But they recognized the 7% boost in energy and transportation sales as volumes increased. It's weird to see them selling more energy and transport equipment. I'm assuming most of that is energy, because everything I've read has said that the transports are in really dire straits here and that the logistics industry is in trouble. But again, the takeaway from Caterpillar, fewer volumes, less things being sold, but for a higher price. Caterpillar stock down 9%. Whoa. Okay, let's refresh because the market's open. They were down 9%. Now a far more respectable negative 7% for Caterpillar. And we got this one going on in India. Wheat stocks in government warehouses at 16-year low after record sales. Keep an eye on global food prices, guys. We're already talking about higher inflation. Indian wheat stocks held in government warehouses dropped to their lowest level in 16 years after 2 straight years of reduced crop yields prompted New Delhi to sell record volumes to boost domestic supplies and bring down local prices. Price controls don't work. They lead to shortages, folks. I've said it a million times on this channel. There it is. Wheat reserves in state stores totaled 7.5 million metric tons at the start of April, down from 8.35 million tons a year ago, according to data compiled by the state-run Food Corporation of India. Over the past decade, wheat stocks on April 1st had averaged 16.7 million tons. The stocks came down as we sold a record 10 million tons last year to stabilize prices, senior government officials said. Despite the tight supply, New Delhi has resisted calls to encourage imports by cutting or removing the current 40% tax, or by buying directly from top suppliers such as Russia. So this isn't going to drive up U.S. wheat prices instantly. India is most likely to buy their grain from the Russians anyway, but they're at that level where India would automatically have to start buying more wheat to replenish their reserves, and wheat prices are reacting. They're up 5 days in a row here. Wheat prices are still pretty low. It's $619. I believe this is priced in dollars per ton here. Don't hold me to that, though. But you can see here all these green candles in a row. Wheat prices have started to rally here, although we're way down versus a year ago. Nowhere near the kind of numbers we saw after the Russian invasion. But this is a story to keep an eye on, because these things have a way of getting out of hand very quickly. And I just want to say thank you very much to Mr. Evan Francis, who says, going to wait for Google and Microsoft earnings before more SPY puts. I smell another Volmageddon. This is the way. I think you're probably smart to hold off here. Look, guys, market is still at ridiculous highs. We've come down off the all-time highs, but zoom out on those charts. Look at where the stock market is versus 3 years ago, 4 years ago, 10 years ago. All right, just because stocks have sold off 4 or 5% doesn't mean there's not more room to the downside. There is so much room to the downside here. That being said, Microsoft could come out and post a blowout today. Google could post a blowout today. We still got NVIDIA earnings coming up in a few weeks here. So a lot could happen. And remember, when you're short, you got to be right about what and when at the same time. So just be careful. We've seen dips like this before to lure the shorts in. That being said, the market is starting to punish anybody who dares to guide for a reduction in growth. Meta's growth numbers have been fantastic. They forecast future growth, but it was lower future growth, and their stock is getting crushed here. If Microsoft does the same, we'll probably see a similar result. Thank you, Evan Francis. I appreciate the super chat and the support of the channel. And thank you to Mark Fragola, who says, my spidey senses are tingling on Deutsche Bank. Interesting that you should mention Deutsche Bank, Mark. Why that one specific? I agree. European banks are probably still in trouble. You know, Silicon Valley Bank got all the attention here in the States last year, but that Credit Suisse failure was massive, way bigger than the bank failures here in the U.S. And it didn't get nearly as much headline. And I agree, Deutsche Bank, when it comes to gross derivatives exposure, Deutsche Bank is one of the biggest cases of counterparty risk in the world. So I think you're right about that one, although there's nothing specific that tells me problems at Deutsche Bank other than some headlines from earlier this year about big losses in commercial real estate starting to hurt them, along with Deutsche Pfandbriefbank and some other German banks. So I think you're right to keep an eye on that one. Thank you, Mark, for the super chat, sir. And thank you. The inflation situation says, love your work, Jack and Co. Shout out to my peeps in the chat. And hello, everybody in the live chat, all you melonheads out there. Thank you very much, the inflation situation, for the good vibes in the morning. I'm right back at you, sir. And Mr. Travis K says, I can always tell if it's a bearish day, even without the thumbnail. Just start watching the enthusiasm in Jack's intro pen drum strike. Well, guys, it's right. They're right there on my sleeve. You can see it in invisible ink. Perma bear. Yes, Jack does get more excited when he sees big red candles. I'm not happy to see people losing money, but this market, this unserious market, victimizes the working people, the average person who's just trying to make a living. It victimizes them so that the muckety mucks, they with a capital T, can get infinitely more rich and raise prices even more on people who are just trying to tread water. So yeah, when I see big red candles, I get a little enthusiastic. I try to remind myself that people losing money is not a good thing. But guys, this economy does not work the way it is. This market does not work. It victimizes people who don't participate in it. And I want to see that change. So hence the enthusiasm on a big down day. I think in the long run, it is better for people that we get that. So thank you, Travis. And thank you for the laugh as well, sir. I appreciate the super chat. Thank you to Kevin DeBella, says, tinfoil hat question. All right. We are donning the tinfoil hat. The Fed is far from independent. I agree. So do they get pressure from the White House to cut before the election, or do they keep the fake strong economy narrative going until November? All right. There is a case, I believe, who was it? Was it Nixon? There's a very famous case from the 70s. I should know this story like clockwork, but I don't. It was a president. It wasn't Nixon. Who came after Nixon? Was it Ford? Threw the Fed chairman up against the wall at I believe it was at his private ranch in Texas or something like that. Basically threw the Fed chairman up on the wall, physically accosted him, something about, my boys are dying in Vietnam. I need lower interest rates so I can borrow more money to fund war and fund death. And that, I believe it was Arthur Burns who did that. He basically acquiesced and gave the president what he wanted. Ridiculous case, ridiculous abuse of power, weakness from the Fed. Ultimately gave the president and the bankers what they want. Now, I am more of the impression right now. First of all, I don't think Joe Biden is throwing anybody up against the wall. He'd probably break his hip if he tried. But I think right now it's kind of the other way around. I think the Fed throws around the politicians the way the politicians used to throw around the Fed. And whoever controls the Fed, the big banking families that, pay to have their name stricken from the entirety of the internet, they're the ones who are really calling the shots. They're the ones who are getting far, far wealthier as everybody else gets poorer. And they like the way things are. So do I think there probably will be political pressure on the Fed? But to be honest with you, keep in mind, Jerome Powell is a Republican. He was a Republican appointee. I think the political pressure on the Fed will be to do nothing this year until after the election, because doing something, cutting interest rates, will be viewed as helping one side. Raising interest rates will be viewed as helping the other side. Now, there's a chance doing nothing will be viewed as helping the Republicans, because doing nothing hurts the economy, or at least, the image of the economy, which is bad for the incumbent. But I think the Fed right now, there's a lot of inertia to stay and do nothing here so that they avoid being viewed as meddling in the election. So that's my tinfoil take on that, but it is a good economy. And I'm sorry I butchered that story. I think it was Ford and Arthur Burns, that case of the president throwing the Fed chair up against the wall, but it's a pretty messed up story. Thank you, Kevin DeBella, for the tinfoil hat product placement. And thank you very much, Nashville Pasta Man, who says the GDP number includes a boatload of government Keynesian dollars. I was very surprised to see them mention a decline in federal government spending in that GDP report. I don't know where the hell they're getting that from, Pasta Man, but there was a big increase in government spending overall, driven primarily by wages to state and local government employees. That was a big one, a big contributor. So there is a little bit of, we'll call that a little bit of Keynesian. What is that? A little bit of a wage spiral inflation going on there. And also all you guys who are talking about stagflation right now, right? Lower GDP growth and higher inflation. We're not quite stagflation right now. The textbook definition of stagflation is high inflation and high unemployment. And although inflation is elevated and moving higher and unemployment is moving higher, both are still kind of low. Don't jump down my throat. They're kind of low relative to some of the highs we've seen in recent years. So we're still a ways off from stagflation, but I would say that this GDP report was stagflationary. And well, stagflation is that economic phenomenon that the Keynesians tell us is supposed to be impossible. And well, the 1970s did happen. So Keynesians yet to really explain that one. And somehow they're still in charge of the whole world. So we got that going for us. Thank you, Nashville Pasta Man, for the super chat, sir. Thank you, Andrew the Great, who says, good morning, Melonhead. Questions. Will we see pre-pandemic silver prices ever again? I was late to the party and prices seem high for the shiny. That's a choice, all right? If the Fed does nothing, if they keep interest rates higher forever, I think we're looking at such a massive deflationary event that silver prices could conceivably return to pre-pandemic levels if that happens. Because you just have so much currency going up in smoke that the price of everything drops and people start selling anything they can to raise money because they're all out of work, including gold and silver. That could conceivably happen. However, see earlier comment about the Keynesians are still in charge. And what do the Keynesians do every time things get rough? They Zerpenberg. They bring back low interest rates and they print money. So if we do nothing, if we just stay exactly where we are right now and change nothing, silver prices would go back to pre-pandemic levels. They go even lower than that. But I think there is a very little chance that we do that because they're more likely to bring back the easy money, which is why stocks are sitting at all-time highs, which is why, everybody is still pricing in so many rate cuts for this year because they know the Fed can't afford deflation because we're $32 trillion, $34 trillion, who's counting, in debt. So I think they have to bring back the easy money at some point, in which case gold and silver prices will rocket higher. So it's possible, Andrew the Great, but it is very unlikely. Thank you, sir, for the super chat, the support of the channel. And thank you to Wonder She Her for the super sticker. I appreciate that very much. And what is the super sticker? It is, it's a melon. Well, he looks like a pear. We'll call it a melon with the coffee. Right back at you, Wonder. Thank you very much for the support of the channel. And thank you, Grandpa, for gifting 5 Nobody Special Finance channel memberships. I appreciate the support of the channel. Guys, if you got one of those memberships, be sure and say thank you to Grandpa down in the comments below. And thank you, Grandpa, for the support of the channel. We ran a little long today, guys, because there is a lot happening today. We'll see, man. Pay attention after hours. Microsoft and Alphabet earnings. If they don't pull some rabbit out of some hat, this market is in big trouble. But for now, that GDP report was terrible. Those Meta earnings were great, but Mark Zuckerberg just had to run his mouth about AI and Metaverse. So the market is punishing it. All you AI bros, put up or shut up. Put up a product that actually adds value that people are willing to pay for. Otherwise, your bubble doth burst. Everybody, thank you for having your coffee with the Melonheads. Until next time, live small and dream big. Oh, yeah. Also, hi, Mom. Hi, Dad. Love you guys. Check out the links down below. See you later, everybody.